China's next move will rain hell on global markets. I'm Steve Van Metre. This trade war bombshell is about to unleash chaos bigger than last week's meltdown. It's coming soon, and I'll show you why. It will send stocks plunging. Now, let's over to Bloomberg, where he picked today's story up with a headline: as yuan devaluation, market chatter grows as trade war worsens. And the reality of this situation, when you are the global reserve currency, it means everybody else has pegged you. This gives every other country some major power in the trade war, says you can put tariffs up as big as you want because we'll just devalue our currency. China now set to be the first one that could potentially make this move. I'm going to show you why it's going to send global markets outright crumbling. China can play hardball with the U.S. on retaliation. A currency move directly addresses any loss of competitiveness. Devaluation risk has gone up here significantly because it's the only move China has left. Because right now we're facing mutually assured destruction of the global economy, but China's risk is they're going to be the first to go. And that's exactly what President Trump wants. He wants every other country's economy to fall, come back to the negotiating table, and it makes perfect sense. They'll be eager to make a deal. But how does the world respond? Again, when you're pegged to the dollar, it's simple. You can raise the tariffs all you want. We're just going to keep devaluing our currency until our exports are still cheaper than what you can offer domestically. And in the end, what we face is a mutually assured destruction of the entire global economy. And let's take a look back, because China has done this before, and that means they're likely to do it again. Let's go back to 2015 when China devalued the yuan. You can see the renminbi shot higher. At the same time, it sent the dollar surging. They did it again during Trump's first term to combat his trade war. And again, it sent the dollar screaming straight up. But it also had another effect. It sent interest rates down, and in a major way, because a lot of people don't realize when the dollar goes up, it tends to put downward pressure on interest rates. Now, why would China be so motivated to do this? Is it just a function of the trade war and being able to have staying power to fight President Trump on this until somebody gives in? No. It has everything to do with, of course, the global reserve. That's the dollar, because in a dollar standard, what China accumulates is treasury securities. But for many years, they've been draining their reserves as the dollar shortage continues to persist. And this is a huge problem. Think about it this way. In a gold standard, what are you trying to accumulate? Gold. In a dollar standard, you want to accumulate treasury securities. And what happens, of course, when you devalue your currency, you send the dollar higher, you send bond prices higher, and interest rates down. And next thing you know, China is back accumulating treasuries. This is exactly the move they want to make. And it's everything to do with how the global economy, at least in its current state, is working. Any bold move on the currency would be a controversial option for authorities, mindful of the negative impact the last time it was used, the shock devaluation in 2015. It hammered yuan assets, spilled over into global securities, involved into a crisis of confidence in China's ability to control the markets, and it sent stock prices crashing. And now we're facing the reality is that the market's starting to price in a recession at the base case. That's the optimistic case. In fact, now markets are even looking forward. We see in the credit markets that perhaps there's going to be a financial crisis. Many of you have said, look, we're facing an all-out depression, and that is actually potentially true. We actually showed you the chart of the last times we saw a big increase in tariffs. Well, that was during the 1920s. Led straight into the Great Depression. Once again, we face the same risk. This time, stocks are already selling off. China's move by devaluing their currency could send them outright plunging. And the rapid devaluation of the yuan can offset costs of tariffs, but it will also incur capital outflows. This is a big problem for China. What did we hear them do recently? They tried to curb and stop outflows. Now, they can't stop all of them, but they tried to put the brakes on it, and hard. Others maintain it's still a powerful tool, made even more relevant today given its ability to swiftly counter trade wars hit to growth. And with China's economy already slowing, it's already in the early stages of recession. What do we see there? Inflation turning negative into deflation. What are we hearing in the factory sector? Demand is slowing down. New order growth is slowing. Workers, domestic consumption, it's not happening because people are worried about the economy. This would be one way to quickly fix it. It's the most obvious way for China to play the imposition of tariffs. I agree completely. And now is starting to get priced in by the markets that China could drop the biggest economic bomb they can, and it would rattle the world, send again stock prices tumbling. But would this cause President Trump to back off? I want to know from you, would a devaluation infuriate him, or would it bring him to the negotiating table? Weigh in the comments because, well, based on what he said on the weekend, he's in it to win it. And don't be weak, don't be a panican, as Trump urges Americans to hold tight as countries from all over the world negotiate on tariffs. Well, and of course they're going to negotiate. That's obvious that everybody's going to come and talk. But it doesn't mean there's going to be a resolution. And that's the issue we're facing right now, is how long do these talks go on, and is there going to be a solution? And is there one that the current administration is going to say, yes, we're all in on that, we're going to bring the tariffs down? Or are we going to see this extend out even further to say, look, you may say you're going to do something, but we need to see you do it. That means this could be drug out far longer than the markets ever thought. And countries all over the world are talking to us. Tough, but fair parameters are being set. I spoke to the Japanese Prime Minister this morning, Trump said on Truth Social, as he's sending a top team to negotiate. Key word here, to negotiate. They treated the U.S. very poorly on trade. They don't take our cars, but we take millions of theirs. Likewise, agriculture and many other things. It all has to change, but especially with China. This is not sustainable. The United States can't lose $1.9 trillion on trade, but at what sacrifice? And that's the issue here, because we've lost well more than that in the equity markets, and we're facing an even bigger decline the longer this goes on. The question I have for you, are the American people going to stand fast and hold and fight? Or are people getting tired of watching their net worth plunge and demand a change? Weigh in the comments below. I want to hear from you what you think happens next. Over the weekend, Trump suggested that market turmoil was part of the plan, saying sometimes you have to take medicine to fix something. But again, that's the question I want to know from you. How much medicine, how much pain are you willing to take before you've had enough? Are you in this to win it too? Or have you already had enough and you're ready to go back to the old system? Because even if stocks are plunging here, it doesn't mean you have to lose a ton of money. In fact, you can even make money in a down market. And how do we do it? With our CTA Timer Pro, we trade against the machines and win. You can see back in March when U.S. equities were falling, we told our subscribers to buy Brazilian stocks, and sure enough, we closed out a 7% gain in less than 2 weeks. And right now, with markets being very volatile, we're watching for our next big trade, and we want you to be in it with us. Grab the links in the description below. Use the coupon code for your 30-day free trial. It's time for you to start making money in this market while everybody else is losing. And speaking about losing, Jamie Dimon says tariff policy issues must be resolved quickly, or the U.S. economy is going to pay the ultimate price. The quicker this issue is resolved, the better, because some of the negative effects increase cumulatively over time. It would be hard to reverse, he said. We're likely to see inflationary outcomes not only on imported goods, but domestic prices as input costs rise and demand increases on domestic products. Well, the reality is input prices are going to go up. That's the truth. But demand for U.S. products going up? Well, not likely, because what's the bigger issue here? Consumers don't have the money to afford prices where they're at now. How are they going to afford them when they go higher, Mr. Diamond? I don't think so. Let's take a look at this chart where you have the consumer price against of total incomes of production and non-supervisory employees. That's shown in red, both on a year-over-year rate of change. And what Mr. Diamond doesn't seem to understand is that when inflation rises and wage growth is stalling out or decelerating, it'll put you right into a recession, because it means consumers cannot afford higher prices. We see that happen again during the dot-com bubble. We see it happen when energy prices surged during the global financial crisis. And we're facing now that the tariffs are going to send consumer prices higher by a significant margin. At the same time, what are we hearing from employers? That they're worried about the future. And when you're worried about the future, you don't give your employees raises or more hours. You get your workload done, and then you send them to the unemployment line. And that means what we're expecting to see from the rank and file American worker is their income is not going to keep up with inflation. And that means demand for U.S. goods not likely to go up, likely to go down, including potential retaliatory actions by other countries, the impact on investments and capital flows, and the possible effect on the US dollar. Now, this is interesting because we noted that if China devalues the yuan, it sends the dollar higher. Now, think about this. It makes Chinese exports even more competitive against US. In fact, it makes them cheaper. So what does that mean at the factory level here? Well, demand will still go down no matter how high the tariffs. It'll put American workers on the unemployment line. And again, we think about what the goal President Trump has for the economy. He wants production here. He wants jobs here. And if China devalues and sends the dollar higher, well, that means more workers are going to hit the unemployment line, an unintended effect that could send us right into a stagflationary recession, something we've said is highly likely. And China deploys rare earths as weapon in trade war with Trump, as now we're starting to see countries fight back at the same time they're negotiating. As part of its retaliation to President Donald Trump's so-called reciprocal tariffs on imported Chinese goods, Beijing said Friday will tighten controls on exports of 7 types of rare earths. Keep in mind that China is the world's biggest supplier of minerals. They actually have an output about 70% of all rare earths. So this is a big issue, particularly as we move towards electrification. And Germany seeks the strongest EU trade tool to hit back at U.S. tariffs, again, sending people to negotiate while they fight back. And we have to take a close look at the anti-coercion instrument, which are measures that go far beyond tariff policy. And what this would allow them to do is target big tech companies. And right now, Americans are heavily overweight big tech. They put a ton of money into tech stocks, believing they could only go higher and to the moon after that. The problem is these big tech companies buy a lot of their stock packed with a lot of their free cash flow. Will we see a change in that? And if Europe comes after, of course, big techs and stock prices plunging even more, it's going to hit the American household in a way that people aren't ready to, because they're already seeing their net worth plunge, and this would cause it to crash even more. And Thailand won't rush to reduce taxes on imports, they said, as again, countries looking to fight. And while negotiations are likely to be drawn out as every country hit by Trump's tariffs is seeking parlays with the U.S. to minimize the fallout, the economic losses of Thailand could be as high as 900 billion baht, or 26 billion US dollars. And here you can see again, they're looking to minimize the hit, but they're willing to talk and then fight. And that wasn't the expectation here. If you want to know why markets are struggling, why they're continuing to sell off, why, of course, the markets are believing that China is going to devalue the yuan, hit the global economy with the biggest economic bombshell they can, is because the reality is everyone thought this trade war would come and go in a flash, and reality is now everyone wants to fight and extend it out. Maybe everyone wants to reshape the global economy, but maybe not to the way President Trump wants. And traders are adding to their bets on a 2025 Fed cut with risk of emergency move, but that may not be the case. We saw people come in and buy the dip on that news today, only to find sellers were eagerly awaiting. And to be sure, Fed Chair Jerome Powell made clear on Friday that he would not rush to ease rates even as turmoil erupts across the markets. In a speech, he stressed that still elevated inflation means policymakers will need to act with caution given the temporary price boost from tariffs. And this is the case I've made about, of course, what the Fed's going to do. They are not going to be able to respond because they know as quickly as these tariffs went up, the tariffs could come down, inflation would come down, and it would jerk them around from a policy perspective, but it would also change their motives because they're supposed to be apolitical. So if they started responding to what, of course, comes out of a current administration, it would change the game. They're going to be data dependent, and they're going to say that inflation is likely to rise. We have to further crush demand by keeping rates up. The problem is higher prices are already going to crush demand. But now let's turn to a former Fed official, the president of the Federal Reserve Bank of New York, Bill Dudley, as he now says, stagflation is now America's best case scenario. So while we know current Fed chief Jerome Powell could not say these words, well, nothing like a former president to come out and say stagflation is now the base case. This is what I said is likely coming, and the evidence is mounting. The impact will be devastating, he said. Over the next 6 months, annualized inflation will likely climb to nearly 5% if tariff boost import prices as domestic producers, shielded from competition, take advantage of the situation to raise their prices as well. And I said that's exactly what's going to happen. They were going to front run all of this inventory. As soon as the tariffs hit, prices are going to go up because businesses need the money. They're going to actually take advantage of this to increase their margins. But what's the problem? They're not going to pass this on as pay raises to their workers workers. We've already heard this from employers that said, look, this isn't likely to happen, meaning prices go up. Workers still can't afford them at today's price, certainly can't afford them if they go up. Demand is going to plunge. You see the recipe as we build into stagflation. Meanwhile, demand will decline. He's spot on with that. Businesses will delay investments amid the uncertainty about duration and breadth of tariffs and about the degree of foreign retaliation. People will cut back on spending as they adjust to what amounts to a tax hike of $600 billion or more, some saying could hit the average American family by $3,000 or more a year. Is this going to, again, cause a huge decrease in demand? At a time businesses loaded up their inventory, you're seeing what's happening here, stagflation. You get inflation up front as demand goes down, and then the unemployment starts to unwind as the labor market weakens, and next thing you know, all of that inflation turns into disinflation, but with the big inventory overhang, could turn into outright deflation. Again, this is something central banks don't want. The asymmetry means the Fed will have to be very careful as the U.S. economy struggles. Any easing of monetary policy that stokes inflation expectations will necessitate a much harsher and costlier tightening later. Hence, I think investors are too optimistic about the likelihood of central bank support. On the contrary, the balance of risks and the high level of economic uncertainty justify a slow response. And this is what I said after Fed Chair Powell spoke last week on Thursday. I said, look, he's going to do nothing. And sure enough, that's what Bill Dudley's saying. Look, he came out and said what Fed chief can't say. We're facing stagflation. President Trump's policies are going to lead to higher inflation, weaker demand. It's going to cause people to lose their jobs. It's going to send the stock market crashing. But anybody looking for the Fed for support isn't going to find it because they can't do it. But meanwhile, Bank of America says hang tight. There could be a turnaround. We'll show you what to look for. But in the meantime, they're saying stay short until hard policy pivot. Here are 5 things that would be bullish. Let's look at 2 of them. One is the put-call ratio, as they note, is the best old school, quote, max fear indicator. When it gets to 1.3, it confirms Wall Street fear gauge and trading opportunities. But it also needs to see some other things sell up. But here's the big one. U.S. gasoline prices, if they fall below $3 a gallon, well, that means that U.S. consumers would get some welcome relief here, maybe put a little extra money in their pocket to spend. So what we need to see here is fear go to the max, and we need to see something change that gives consumers some ability to spend. But in the meantime, Bank of America says get short and stay there if you're not. But whatever happens in the markets, our subscribers are set to take big advantage of it. Let's talk about our CTA Timer Pro, where we look at machine positioning each and every day across the broad equity, bond, currency, and commodity markets. But what happens is machines look at very short-term periods, but what we've done is we've run a historical overlay till we knew when the machines were going to sell off this market ahead of them, and we warned you, and we know when the machines are likely to turn around because our models tend to lead where the machines go. If you want to get in on that, you can. There's a 30-day free trial. Links in the description below, because every day you get the report, you get our hot list with all the integrated backtest data, and we give you the positioning across all the different asset classes. You get the daily report, you get all the tradable signals, you get my opinion on the best trades. That's right, I review each and every one of them. You get risk control levels, full tracking of all of our open trades and returns, a weekly update. Here's the best part, a 30-day free trial. That's right, your first 30 days on me. All you do is grab the links in the description below, use that coupon code, and you're in. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.